Hey, how's it going? Today I'm going to be talking about initial public offering and what that is. An initial public offering, or IPO, is the first sale of company stocks to the public. It's a significant financial event for a company and represents a transition from being privately held to become publicly traded company. Here is how IPOs typically work. Preparation before going public, company needs to prepare itself for our initial public offering process. This involves financial audits, legal compliance, and meeting regulatory requirements. The company also needs to hire investment banks, underwriters, and legal advisors to help with the process. Filing with regulatory authorities. The company must file registration statements, typically with the Securities and Exchange Commission in the United States, outlining its financial information, business operations, risks, and other relevant details. This document is known as prospectus. Underwriting. Investment banks and underwriters help the company determine the offering price and the number of shares to be sold to the public. This also assists in marketing the initial public offering to potential investors. Roadshow, the company's executives along with underwriters enter roadshow to promote initial public offer to institutional investors, analysts, and potential buyers. During these presentations, they provide information about company's financial health, growth prospects, and other key factors that might influence investor decisions. Overall, uh, pricing. After a roadshow, underwriters and company executives set the financial offer price for the shares. This price is often based on investor demand and market conditions. Once the initial public offering is priced and shares are allocated to investors, they become available for trading on the stock exchange. Investors can buy and sell these shares like any other public trading stock. After the initial public offering, the company is subject to various reporting and disclosure requirements, and its financial performance and operations become more transparent to the public. Shareholders can freely trade their shares on the open market. Initial public offerings are often seen as a way for companies to raise significant capital to fund growth, pay off debt, or provide an exit strategy for early investors and founders. However, going public also comes with increasing regulatory securities and transparency requirements, as well as need to manage stakeholders' shareholders' expectations. Investing in initial public offering can be attractive to investors looking for opportunities to buy shares in companies at the early stage of public journey, but it also carries risk as the price of initial public offering shares can be volatile in the initial trading period. It's essential for both companies and investors to carefully consider the benefits and challenges associated with initial public offering. Myself, I didn't have a chance yet to take any company public. I have read about it, I know about it, but I haven't done it myself. There are a lot of mixed opinions about all the process, as well as taking your company that you worked on for so many years publicly, and all the process and everything what comes with it. It's very mixed opinions, but I can understand all the pros and cons. I'll try to highlight some of those. Some of the pros of taking a company public can be access to capital. Initial public offering provides significant influx of capital to the company, allowing to fund growth initiatives, pay off debts, or invest in research and development. Liquidity for investors and initial public offer can offer early investors and founders the opportunity to sell off their shares, realizing their investments and potentially profiting from the company's success. Increased visibility. Going public can raise a company's profile and brand recognition, potentially attracting more customers, partners, and business opportunities. Stock as currency. Publicly traded shares can be used as form of currency for acquisitions, margins, and attracting and retaining talent throughout stock-based compensations. Yeah, it's just because I'm reading a lot of books, right? One of them would be Rockefellers and how sometimes they would buy out some of the companies and what kind of process they undergo with overall acquiring a lot of market shares. And sometimes by offering shares that they can acquire a lot of market share, which is interesting strategy overall. uh, Valuation benchmark and intellectual property establishes a public market valuation for the company, which can be used as a benchmark for future financing rounds as strategic decisions. Diversification for founders and early investors and IPO allows them to diversify their wealth by converting liquidity private shares into publicly traded assets. Some of the cons or disadvantages that would be regulatory compliance. Public companies face the straightened regulatory requirements, including financial reporting, disclosure, and compliance with security laws, which can be costly and time consuming. Since you undertake the process and you need to maintain the standard. Loss of control. Going public often means the dilution of ownership, and new shareholders are added, potentially reducing the control founders and early investors have over the company's direction. I hate this one the most personally, over taking or giving away some of the control of the company and the overall decisions. What I might be a part of the process overall. Short-term pressure. Public companies may face pressure to meet short-term financial expectations, which could lead to decisions that prioritize quarterly results over long-term growth. If I have a company who is manufacturing the diesel or petrol engines, and if that company would decide to take different direction, perhaps manufacture different cars, and if you had a lot of stakeholders in the company that might be affected, but overall that's part of the process. Disclosure of information. Public companies must disclose sensitive finances and operational information, which can be disadvantaged in terms of maintaining confidentiality and competitive advantages. Market volatility. Stock price of newly public companies can be highly volatile, making it challenging for early investors to predict or control the value of their holdings. Cost. Process of going public, including underwriting fees, legal and accounting expenses, and ongoing compliance costs can be substantial and impact profitability. There are a lot of good books where they're sharing all overall some of the administration fees, which I consider just administration fees, and a sharp increase that a lot of companies can face after going public, but overall, it's just the way how you negotiate those fees, and perhaps that could be implemented for all your strategy and how you're gonna manage potentially sharp increase in overall administration fees. Security and stakeholder activism. Public companies are subject to increased security from shareholders and analysts and activists, which can lead to public disputes and pressure for change in management or overall strategy. For anyone who's interested, starting and launching your first business, I believe it's one of the best books that you can read. This book is focusing on the system processes and all the research work that you would need to do if you're looking to start your livestock enterprise, and what information you would need to know, and some of examples and lessons, real life examples that I'm sharing within the book. I'm sharing an example of the couple from Australia and how they do it. They have done it, and how they're currently doing it, and those lessons can be learned and adapted for wider reach of people who are interested. You can find this book in the description. If you go under the studio, there's a link into company's website. You can purchase this book there. In the book, I'm sharing a first milestone and how to reach it from 0 to first 10,000. As well as you can purchase this book on top retailers like Amazon or others. Just to summarize, in essential for company and its stakeholders to carefully weigh these pros and cons before deciding to go public throughout initial public offering, as the decision has far-reaching implications for the organization's future operations and governance. Thanks for watching, and I'll see you in the next one.